Hello, Namaste and welcome you all. In this lecture we are going to take problem number 6 on marginal costing technique. So let's start. This is our problem. In our problem, data of Siddhivinayak Limited is given. In Siddhivinayak Limited, the sales and profits for the last two periods is given. Period 1, sales are 1 lakh, profit for period 1, 9,000. Then period 2, sales rupees 1,20,000 and profit rupees 13,000. With this data available, we are asked to calculate PV ratio, fixed cost, BEP in rupees, then profit when sales are rupees 1,50,000 and sales to earn profit rupees 50,000. Then margin of safety in period 2 and variable cost ratio, and lastly variable cost for both period 1 and 2. So let's start our solution. First we are asked to calculate the PV ratio, and whenever the data of sales and profits of last 2 years is given then we can use that data to calculate our PV ratio. So which formula we can use to calculate PV ratio? Change in profit upon change in sales into 100. That formula we can use to calculate our PV ratio. So PV ratio is equal to, what is the formula? PV ratio is equal to change in profit upon change in sales into 100. Now you can see period 1 sales was 1 lakh, it is increased to 1,20,000. So sales is increased by 20,000. So sales is changed by 20,000. So sales is changed by 20,000. Change in sales is of 20,000. You can see in first year sales was 1 lakh. In second year sales became 1,20,000. So sales is increased to 1,20,000, means it is increased by 20,000. 1 lakh to 1,20,000, increased by 20,000 or changed by 20,000. So change in sales we have taken 20,000. Then change in profit. So change in profit, first year profit was 9,000, it is increased to 13,000. So 9 to 13, it is increased by 4,000. So profit is increased or changed by 4,000. That's why change in profit is equal to 4,000. So change in profit 4,000 upon change in sales 20,000 into 100. So answer is 20%. Means our PV ratio is 20%. Okay, so first atom of the problem we have calculated, that is PV ratio. Now we are going to calculate the second atom, that is fixed cost. So how to calculate the fixed cost? By using contribution we can calculate the fixed cost. As we know, contribution includes two contents. Which are these two contents? Profit and fixed cost. So we have amount of profit. If we deduct the amount of profit from the amount of contribution, what will remain? Fixed cost will remain, and in that way we will calculate the amount of fixed cost. So to calculate fixed cost in that way, we have to calculate first the amount of contribution. And how to calculate the amount of contribution? As we have already calculated PV ratio, by using PV ratio we can calculate the contribution. As we know, PV ratio means profit volume ratio, or it is also called as contribution ratio or contribution to sales ratio. So whenever we multiply PV ratio and sales, we get the amount of contribution, because as we know what PV ratio tells us. PV ratio tells us the contribution of PV ratio tells us the percentage of contribution to sales. That's why whenever we multiply sales by PV ratio, we get the amount of contribution. In that way we will have to calculate the amount of contribution first, then we will deduct the amount of profit as given in the problem, then fixed cost will remain. So second item we are going to calculate, that is fixed cost. So how to calculate the same? Fixed cost is equal to contribution less profit. So profit amounts are given, already given. We have to calculate the amount of contribution now. So contribution is equal to, which formula we can use? Sales into PV ratio. So sales of any year we can take. So just take sales of period 1. Sales are 1 lakh. 1 lakh into PV ratio, that is contribution ratio, which is 20%. So contribution amount 20% of 1 lakh is 20,000. So 20,000 is the amount of contribution. So we have calculated the amount of contribution, which is 20,000. Now same amount of contribution we can use to calculate our fixed cost. So as we have discussed, fixed cost is equal to contribution less profit. So contribution of period 1, which we have calculated, which is 20,000. So 20,000 contribution less profit of period 1, which is 9,000. So 20,000 less 9,000 is equal to 11,000 is the amount of fixed cost. So fixed cost is rupees 11,000. And as we know, the cost structure of two periods is assumed to be equal, because it is an assumption of the marginal costing technique that per unit variable cost, per unit selling price and fixed cost or cost structure remains same irrespective of the changes in the volume of output or production. So that's why we have calculated fixed cost. The second item of problem we have calculated fixed cost. Now we are going to calculate third item, that is BEP rupees. So third, BEP rupees, that is break even point in rupees. How to calculate the same? Which is the formula to calculate BEP rupees? Fixed cost upon PV ratio. As we have discussed, we have taken here the amount of fixed cost as the amount of contribution at which level? BEP level. Because as we know, the amount of fixed cost and the amount of contribution at BEP level is always equal. That's why we have taken amount of fixed cost as a amount of contribution at BEP level. So amount of contribution at BEP level divided by contribution ratio is equal to sales at BEP level. In that logic, we can calculate the PV ratio. So fixed cost as we have calculated, which is 11,000. So 11,000 is our fixed cost divided by PV ratio, which is 20%. So 11,000 is 20% of which amount? 55,000. So 55,000 will be the amount of BEP rupees. So in that way we have calculated third item of our problem. Now we are going to calculate fourth item. Profit when sales are rupees 1,50,000. Means what will be the amount of profit when company's sales are 1,50,000. How we can calculate the same? First of all, we will have to calculate the amount of contribution when sales are 1,50,000. Then from that amount of contribution we will have to deduct fixed cost which we have calculated. Then the remaining amount will be the amount of profit. So let's start calculating profit when sales are rupees 1,50,000. Profit when sales rupees 1,50,000. So to calculate profit when sales are rupees 1,50,000, first of all we will have to calculate contribution. So contribution is equal to sales into what? PV ratio. So sales are 1,50,000. 1,50,000 into 20% is equal to 30,000. So 30,000 is the amount of contribution. Okay, means whenever sales are 1,50,000, then what will be the amount of contribution? That will be rupees 30,000. Okay, now we can easily find out the amount of profit. So profit is equal to contribution less fixed cost. So here contribution as we have calculated, which is 30,000 less fixed cost, which is 11,000. So 30,000 less 11,000 is equal to 19,000 is the amount of profit. Means whenever company's sales are 1,50,000, what will be the amount of profit? Amount of profit will be 19,000. So in that way we have calculated fifth item of the problem also. Now we are going to calculate sales to earn profit rupees 50,000. Means if company wants to earn profit rupees 50,000, then how much sales company will have to generate? That amount we are going to calculate now. So let's start calculating the same. Item number 5. Sales to earn profit rupees 50,000. How much sales company will have to generate to earn profit rupees 50,000? So which formula we will have to use? The formula to calculate sales for desired profit. How much profit company desires to earn? 50,000. So sales for desired profit, that formula we will have to use now. So let's calculate sales to earn profit rupees. Sales to earn profit rupees 50,000. So which formula we can use? Sales for desired profit. So which is the formula? Sales for desired profit is equal to fixed cost plus desired profit upon PV ratio. So we have the amount of fixed cost which is 11,000. So 11,000 fixed cost plus desired profit. How much profit company desires to earn? 50,000. So 11,000 fixed cost, desired profit 50,000, and divided by PV ratio which is 20%. So 11,000 plus 50,000 is equal to 61,000 divided by 20%. So 61,000 is 20% of 3,05,000. So 3,05,000 will be the amount of sales to earn profit rupees 50,000. Means if company wants to earn profit rupees 50,000, how much sales company will have to generate? Rupees 3,05,000. So that item number 5 also we have calculated. Now we are going to calculate the item number 6, that is margin of safety in period second. As we know, the margin of safety is nothing but the part of total sales. When we split total sales into two parts, the first part will be the BEP sales and second part will be the margin of safety sales. So we have already calculated first part, that is BEP sales. So we have actual sales amount, the same BEP amount we will deduct, and the remaining amount will be the amount of margin of safety for period second. The same logic we are going to use now. So let's start calculating margin of safety for period second. Margin of safety for period second. So margin of safety is equal to, what is the formula? Actual sales less BEP sales. So BEP was 55,000. BEP was 55,000. Means the BEP is for period 1 and second also. Because why? Because cost structure remains same in marginal costing. That's why BEP remains same for period 1 and second. Means 55,000 is a BEP sales for period 1 also and 2 also. So actual sales of period second are 1,20,000. So 1,20,000 actual sales less BEP sales 55,000 is equal to 65,000. So 65,000 is the amount of margin of safety for period second. Amount of margin of safety is 65,000. So in that way we have calculated the margin of safety for period second. Now we are asked to calculate variable cost ratio, that is VC ratio, which is also called as marginal cost ratio. As we know, the variable cost and marginal costs are one and same. So VC ratio we have to calculate. We have already calculated PV ratio, which is 20%, and whenever we know the PV ratio means we know the variable cost ratio also, because PV ratio means contribution ratio. So sales less contribution ratio is equal to VC ratio. So which formula we can use to calculate variable cost ratio? 100% less PV ratio is equal to VC ratio. That formula we can use now. So atom number 7, that is variable cost ratio. Which formula we can use? VC ratio is equal to 100% less PV ratio. This formula we can use now. So 7th, VC ratio is equal to, what is the formula? 100% less PV ratio. So 100% less PV ratio, which is 20%. So 100% less 20% is equal to 80% is the VC ratio. So VC ratio is 80%. VC ratio is 80%. It means what it tells us? VC ratio or variable cost ratio or variable cost to sales ratio is 80%. It means variable cost is 80% of sales. What VC ratio tells us? It tells us the percentage of variable cost to sales. It means variable cost ratio is 80%. It means the variable cost is 80% of sales. So whenever we multiply variable cost ratio and total sales, we get the amount of variable cost, or in other words, sales into VC ratio is equal to variable cost. By using that formula, we can calculate the variable cost, which is we are asked to calculate lastly. You can see variable cost for both period 1 and period 2. For period 1 and 2, we are asked to calculate the variable cost. So let's start calculating variable cost for period 1 and 2. So which formula we can use to calculate the variable cost ratio? Variable cost. Variable cost is equal to sales into VC ratio. That formula we can use. So for period 1, VC is equal to, sales for period 1 are 1 lakh. So 1 lakh into VC ratio, which is 80%. So 1 lakh into 80%, that is 80,000 is the amount of variable cost for period 1 is 80,000. So sales 1 lakh into VC ratio 80% is equal to 80,000 is the amount of variable cost of period 1. Now variable cost of period 2nd. Variable cost period 2nd. Sales into VC ratio is equal to variable cost. So sales for period 2 are 1,20,000. So 1,20,000 into 80% VC ratio is equal to 96,000. So 96,000 is the amount of VC variable cost of period 2. So in that way we have calculated all the 8 items which we are asked to calculate. So I hope all of you have understood it. Thank you.